The Federal Reserve just cut interest rates for the third time this year, a move that's about to ripple through the entire financial world. But here's the twist. While that sounds like fantastic news, your mortgage lender probably isn't rushing to lower your rates. And your savings account, it's about to be hit in a way most people won't see coming. There's a critical detail hiding in the bond market that almost no one is talking about, and it could completely change how you save and borrow for the next year. In this video, we're breaking down what this historic move is, why it's happening, and what it means for your home, your savings, and your investments. We're going beyond the what to the so what and the now what, the moves you should be thinking about today. All right, let's get into the headline. On December 10th, 2025, the Federal Reserve, led by Jerome Powell, announced another cut to its key interest rate, the federal funds rate, by 0.25%. This brings the target range down to between 3.50% and 3.75%. Now, this wasn't random. It's the third time they've done this in 2025, right after the cuts in September and October. When the Fed acts 3 times in a row, they're not just testing the waters, they're sending a loud and clear signal. So the big question is, why do this? Is the economy secretly in trouble? The answer is a little more complicated than a simple yes or no. Officially, the Fed is looking at a cooling labor market and wants to keep the economy on a stable footing. Job growth has been slowing, and the unemployment rate, while still low, has been creeping up. Think of these cuts less as a panic button and more like insurance. The Fed is trying to steer the massive ship of the U.S. economy away from rocky shores before they even appear on the horizon. This move takes interest rates to their lowest level since 2022, pushing us toward what economists call the neutral rate. A neutral rate is that theoretical sweet spot where policy isn't hitting the gas, but it isn't slamming the brakes either. Basically, the Fed is taking its foot off the brake to see how the car cruises on its own. But here's where it gets interesting. This decision wasn't unanimous. 3 voting members dissented. 1 wanted a bigger 50 basis point cut, while 2 wanted to hold steady and not cut at all. This split is huge for us as investors. It tells us there's a real debate happening inside the most powerful financial institution in the world. The path forward is uncertain, which means more potential choppiness for the markets. Okay, the Fed cut rates. Your first thought is probably, awesome! My mortgage is about to get cheaper. And in theory, you're right. Lower Fed rates are supposed to bring down borrowing costs, which should make mortgages more affordable and add some fuel to the housing market. But here's the part that trips everyone up. You see the news, you call your lender, and the rate they quote you has barely moved. Why? Because the federal funds rate that the Fed cuts is an overnight rate for banks. It's super short term. A 30-year fixed mortgage is, well, a 30-year loan. Its rate is much more connected to the yield on the 10-year Treasury bond, which is what lenders use to price long-term risk. So, while the Fed's move applies some downward pressure, it doesn't just drag the 10-year Treasury down with it. In fact, if the market believes these cuts will spark inflation or stronger growth later, that 10-year yield can stay stubbornly high. So, what are the real numbers? After the cut, the average 30-year fixed mortgage rate did dip to around 6.30%, which is down from the highs of 6.74% we saw earlier in the year. The 15-year fixed is hovering around 5.56%. So yes, we've gotten some relief. A drop of about 0.5% might not sound like a game changer, but on a $400,000 loan, that's roughly $100 to $120 back in your pocket every month. That's over $1,000 a year, which can be just enough to bring some buyers back from the sidelines. For real estate investors, this is a cautiously optimistic sign. Historically, a lower rate environment is good for property values. But remember that stubborn detail I mentioned? The 10-year Treasury. Right now, it's holding firm around 4.16%. As long as that number stays high, there's a ceiling on how low mortgage rates can really go. The outlook for real estate is a gentle tailwind, not a hurricane. Expect more stability, but don't expect the low rate frenzy we saw a few years ago. Let's flip from borrowing to saving, because this is where the rate cut has a direct and for most people negative impact. If you've been enjoying those juicy returns on your savings, I'm sorry to say the party is starting to wind down. Unlike mortgages, the rates on high-yield savings accounts and money market funds are tied directly to the Fed's rate. When the Fed cuts, banks can borrow from each other more cheaply, so they don't need to pay you as much to hold your cash. The competition for your deposits cools off almost instantly. That high-yield savings account that was proudly paying you over 4% is about to get a haircut. You'll probably see an email from your bank soon letting you know your APY is being adjusted downward, likely drifting toward the Fed's new upper limit of 3.75%. The one small safe harbor? Existing CDs. If you locked in a one-year CD at 4.5% 6 months ago, you're golden until it matures. But when you go to roll it over or open a new one, the rates will be lower. The window to lock in those peak rates is closing as we speak. What's the big picture here? The Fed is deliberately making cash a less attractive place to be. For the last couple of years, cash was king. You could get a great risk-free return by doing nothing. Now, the Fed is trying to nudge you out of that comfort zone. They're saying, that pile of cash is about to become lazy money again. We want you to invest it. This rate cut is an explicit push to get investors to take on a little more risk to find a decent return. Playing it safe is becoming less rewarding by the day. By the way, if you're finding this breakdown helpful and want my deep dives on specific investment strategies before everyone else, check out my private newsletter at the first link in the description. It's where I share my personal moves and the exact steps I'm taking in this market. Okay, let's get into what to do now. This brings us to the most important question. Now what? We know what happened and why it matters. Let's talk about what you can actually do about it. First, it's time to rethink your cash. The era of high risk-free returns on cash is over. Your first action item is to audit your savings. How much do you have and where is it? If your high-yield savings rate is about to drop, figure out how much you truly need for emergencies, your 3 to 6 month fund, and how much is about to become underperforming lazy money. For that excess cash, if you're not quite ready for the stock market, you should seriously consider locking in a CD right now. Rates haven't plummeted yet, but they will. Securing a 12 or 18-month CD today guarantees you a solid yield while you figure out your next move. Second, reevaluate your stocks for a lower rate world. Think of interest rates as gravity for stock prices. When gravity gets weaker, certain things fly higher. Historically, falling rates are a powerful tailwind for growth stocks, especially in tech. These companies are valued on big profits that are far off in the future. When interest rates fall, those future profits suddenly look much more valuable today. On the other hand, some sectors face headwinds. Banks can struggle because their profit model, borrowing short-term and lending long-term, gets squeezed. But another group becomes much more attractive: solid, dividend-paying stocks. As the yield on your safe savings account falls toward 3.5%, a blue-chip company paying a 3 or 4% dividend with the potential for growth suddenly looks incredibly compelling. The hunt for yield is on, and it will drive many investors from cash into reliable dividend stocks. Third, don't forget about bonds. For the last 2 years, bonds have been a terrible investment because as rates were rising, bond prices were falling. Well, that whole dynamic has now flipped. When interest rates fall, the prices of existing bonds go up because their higher coupon rate is more valuable than what new bonds are offering. If the Fed keeps cutting rates, the period of pain for bondholders is likely over. Now's the time to look at bonds again for what they're supposed to do: provide stability, income, and a hedge if the economy slows down. Section 5, the future, what to watch for. So where do we go from here? The Fed has made it clear. Their next moves are data dependent. They are flying the plane by looking out the window, and they're watching two gauges on the dashboard: inflation and unemployment. The unemployment rate was 4.4% in September, and this is where we see a fascinating tug of war. The Fed's own projections, their famous dot plot, suggest they only expect to cut one more time in all of 2026. But the market? The market is pricing in 2 or even 3 more cuts next year. So who's right? The economic data will decide. The next Fed meeting is January 27th. Between now and then, all eyes are on the jobs reports. If we see unemployment tick up past the 4.5% mark, the odds of another cut in January will soar. But if jobs stay strong or inflation comes in hot, the Fed will feel justified in pausing and the market will have a reality check. So let's bring it all home. the Fed's third rate cut is a clear signal that the environment has changed. For real estate, it's a gentle boost, but one that's capped by long-term rates. For your savings, it's a direct headwind that you need to manage. And for your investments, it's a green light to rethink your strategy, potentially shifting toward growth and dividend income. The next few months are critical as we watch the battle between a weaker job market and stubborn inflation. The path isn't guaranteed, which means being an informed, agile investor is more important than ever. Now, I really want to hear from you. When you look at your own finances right now, your bills, your goals, your income, does it feel like things are getting easier, harder, or just different? Let me know in the comments below. I read every single one. And finally, if you want to stay ahead of the next market-moving news, make sure you're subscribed with the notification bell on. You should absolutely check out the video on your screen now, where I break down the top ETFs to consider in this new environment. Thanks for watching, and I'll see you in the next one.